Let's bring in now Tuna Amobi, CFRA consumer cyclical analyst. He has a buy rating on Netflix, a $400 price target. Does any of that change today, Tuna?
Vonnie, good morning. Thanks for having me. Our outlook essentially hasn't changed, although I have to say that the Q2 underperformance really was a major surprise to us as we started to parse the release. It pretty became clear that they had significantly over forecasted the expectations, and I can point a finger to the seasonality, the timing of the content slate, and also I think the potential pull forward impact of the record Q1 subscriber growth, which seemed to impact Q2. And lastly, I would also mention the price increase that they had just implemented seemed like it resulted in some elevated levels of churn and lower than expected retention. So all of those factors put together is why I think there was a significant miss in Q2 subscriber growth.
Tuna, is it a stretch to say that this is the first sign of saturation in the streaming market, the direct-to-consumer market?
Well, certainly those are valid issues to bring up now. I will say, though, that the company, now they have more than 2 weeks of Q3 in the belt, and they mentioned that they have seen a re-acceleration of subscriber growth thus far in Q3. That being said, they've talked about 60 to 90 million addressable market in the U.S. Now they've crossed the lower end of that point. It's a valid question to see, to begin to question whether they can actually achieve the higher end. So there's some saturation, no question about that. The competition has intensified a lot, and what we think now is that the next frontier is going to shift to international, where I think the competition hasn't quite reached the level of intensity that we're seeing in the U.S.
Would it be a time to buy on this weakness, Tuna? Reed Hastings is saying, 7 million subscribers is what they're targeting this quarter.
That's right. 7 million is nothing to sneeze at. As a matter of fact, we were surprised that they guided to such a strong number, relatively speaking, especially coming off this quarterly miss in Q2. I have every expectation that they will reaccelerate and potentially maintain the kind of trajectory that we've seen from Netflix. So nothing, fundamentally speaking, has changed in terms of the secular trends driving subscriber growth, broadband penetration, etc. I think the main question is valuation, right? So this pullback, to your question, we think it's a good time to add positions. Granted, there's a fair amount of valuation premium at these levels, but there's nothing, to make us fundamentally change, except for the fact the studios are now pulling off their most popular content off of Netflix platform. This is something they've addressed in this quarter, which I believe they've seen the handwriting on the wall for quite some time.